Awesome. Awesome. Well, good evening, ladies. Good evening. Happy Wednesday, and welcome to day 2 of the Homeownership Made Easy 3-day virtual challenge. Just to recap of what we discussed yesterday. Yesterday, we talked about the current woes and we touched on mindset and how important it is to really shift your mind from consumer to becoming a producer, owner, investor, and how that'll help you along your journey through homeownership, because real estate is a business. And so when you think of it as a business, you know that all your decisions that you make will be made based on the numbers. It has to make financial sense. All right. And so we did get that announcement today, right? And I all over my timeline, I literally just put my phone down. I was like, I'm not receiving any of that as negativity. I personally believe that by this increase of this incremental amount, that we are on the path of recovery. So always when you change the way you look at things, things begin to change. And as we're embarking on the spring market, they're going to be having a whole nother conversation. All right, so let's get started. All right, so for those who weren't here last night, welcome. And also congratulations for those who were here last night. Welcome again. And congratulations to you again. You showed up for day 2. Oh, sorry, guys. Day 2 of the Homeownership Made Easy challenge. And so this just shows a commitment to you and your goals of homeownership. As I said yesterday, an investment in knowledge pays the best interest. And so what you receive over these few days, once you implement it, I'm sure you're going to see a shift. You're going to feel a shift. As one of the ladies said in their homework, she felt energized, right? Because once you receive and then you apply, the only thing left is for you to produce. All right. And so just a little bit about me, recap. I'm a mom of one, Jesus girl. I have a daughter, eldest child of both of my parents, to be honest. Had parents that had me very, very young. And so I lived a life of a lot of responsibility. And of course, I witnessed a lot of struggle. Because as a young parent, okay, Karen, thank you for joining us. With young parents and very little life experience, they're kind of just figuring it out along the way. And so as being the eldest, I had an opportunity to make different decisions. And so that's why I'm here. I've been a mortgage broker for almost 22 years. And I entered into entrepreneurship mainly because I think the word would be best describe me would be like kind of rebellious, right? I don't like to be told what to do. And so when I was working my 9 to 5, I just felt so constrained and wasn't producing anything. I was just doing the mundane, get up, be somewhere a certain time, have to leave a certain time, could only go to the bathroom for a certain, it was just not working for me. And so I didn't realize until later on that I actually had the entrepreneurial spirit in me, because I actually started my own home-based business, that's terminology we use now, at the age of 13. I started doing hair for my mom, her friends, my neighbors. And so it didn't manifest until I was an adult, but I know that I was destined to be an entrepreneur and to break the limits and break generational chains in my family. So I do a lot of different things. Aside from mortgage brokering, I am a life insurance agent because I believe that financial literacy is very, very key and it's missing from so many households. And so when I do sit down with somebody to talk about a mortgage, my goal is to really have a holistic conversation about their finances, because a mortgage is a big, big deal. And so if you're not managing your money on it before getting a mortgage, you may not be moving ahead. You may setting yourself back financially. So that is my goal. I'm a financial educator, and I really try to share as much knowledge as I can in order for the community to move ahead. And so as I was maturing, and I told you, I didn't like the 9 to 5 thing, I had actually purchased my first property at the age of 23. And so that little experience with real estate is what really opened up my eyes to what life could be like if you do things differently. So we grew up in housing, but there was no real example. No one taught me about real estate and what it could do. I just knew that if I moved, I would either pay myself or pay someone else. And so making that decision to pay myself role snowballed into me becoming a mortgage agent, and here 22 years later still doing it, still loving it, with even with the woes, even with the strain of not being able to help as many get into the industry. But it is a life-changing career, it's a life-changing industry, and I would have it no other way. So thank you for being here. So my mission, I've been working with families, but after I had my son, life definitely changed. My mindset changed. It wasn't only about things that I wanted, it was for how I was going to set myself up for him and his children's children, right? And so my personal mission in life rolled into my business, and I've committed to helping moms garner the information that they need, access the resources and the opportunities that will help them begin their homeownership journey and grow a real estate portfolio. And so I put a number on it, 1,000. Just sounds like a really big number. So you being here, even if you're a mom or not, just know that you're contributing to the mission, the greater mission. And so I'm truly, truly thankful that you are here. All right, so tonight we're going to be talking about the numbers and affordability, because real estate is a big deal and it costs a lot of money. So you got to make sure that you are ahead of the game in knowing what you're getting yourself into. So we're going to start with a little self-talk, and feel free to open your mics and respond, or you can type in the chat. So I'm going to go through a couple questions, and I want you to ask yourself these questions as we're going through. So the first question I would ask you to ask yourself is, am I financially stable? And what does financially stable mean? It means that you're no longer in a position where you're living paycheck to paycheck, or there's just enough, you're just getting by. You actually are in front of your finances and are really telling it what to do. It's not telling you what it can do. You may not have reached the pinnacle of your finances, but you're not stressed about where you are financially. So that is something that really needs to be thought of. I've had several conversations with clients that have the aspiration to become a homeowner, but then when we look at the numbers, it just doesn't make sense. And not only because we are in one of the most expensive cities to live in, but because their income just doesn't match their expenses, right? And so it has to really, really make sense. I'm all for ambition, but I'm not saying that it's impossible. You have to make sure that your finances are in a position where you're not going to be straining yourself, okay? So ask yourself that. The next question I'll ask you to ask yourself is, do I have the financial management skills and discipline to handle this large of a purchase? I missed a word. Buying groceries, buying cars, buying vacations, all of that still doesn't equate to the actual size of this transaction. A mortgage, hundreds of thousands of dollars. I've had one client who we've been having conversations for about, I would say on and off, about 12 years. And she literally is paranoid of having that large of a debt attached to her name. She has a very solid job. She doesn't have a lot of debt, very, decent with her money, but the thought of owing someone hundreds of thousands of dollars gives her anxiety. And so she realizes that she doesn't have the financial management skill set because she would be living in fear. And that is totally goes against what you're trying to do when you're investing in real estate. All right. So ask yourself, do you have the skill set? Right. I used to say, if you pay your rent, you'll pay your mortgage, which is true to some degree. However, when you're as a homeowner, there's a lot more expenses attached to that title. And so it's a little bit more risque, so to speak. And so it does require a different level of discipline because you are now the landlord. You don't have anyone that you can call if something, needs to be repaired. So discipline and financial skill set is essential. Third question, am I ready and able to take on the responsibility for all the costs that come with being a homeowner? The transition from being a renter to a homeowner, again, we talked about mindset last night. That is something that you also have to adapt because, as I just mentioned, you are now your landlord. There's no one that you can pick up the phone and call or complain to when something goes wrong. And I guarantee you something will go wrong. If it's not the toilet, it'll be the lock on the door. Raccoons, they believe that they own property, so they will eat out, parts of your roof. There's so many things that can arise when you become a homeowner that will be over and above the expenses that you budget for. Can you manage that? Some people can't, some people will just adapt, but it's definitely something you got to think about before you make the step. This is my favorite question. Will I still be able to continue saving for myself and my children with our short-term and our long-term financial goals? I mentioned the term house poor yesterday. Purchasing a house, again, costs more than renting somewhere. And when you are making that investment, it's not supposed to cripple your finances, right? There's other things that you have to do. You have to plan for retirement. If you have children, you got to plan for children's education. Even if you want to go on vacations, those are things you got to plan for. So if you are purchasing a home, will it prevent you from doing those things? All right. So you got to look at the numbers. Oh, how did I get here? Oops, sorry, guys. What happened there? Hold on. Yeah. Promise you, I'm not a newbie. I know what I'm doing, so I don't know what's happening. All right. So the famous question is, how much money do I need to purchase a home? That's usually how conversations start. Or they start with, oh, I've saved $20,000 and I'd like to buy a home. That is excellent. Saving $20,000 in this day and age is, difficult for many. So if you do that, you've done that, congratulations. But again, there's more components to the actual purchase than the down payment. Most people are really only focused on the down payment. All right. It's essential, but it's not the only thing. And so this is what I believe most people should be focused on when planning to purchase. All right. This is what your budget actually looks like. These are the different things that you are responsible for, give or take one or two of them, that if you purchase a house and your funds can't stretch for everything, something's going to fall short. All right. And I don't want you to think of homeownership as a step backwards, right? When we do our pre-qualifications or qualifications for mortgages, as I mentioned yesterday, there's only just a fraction of expenses that we use to tell you what you can purchase for, right? We don't factor in 80% of what's listed here. So looking at the bigger picture, I stress, is so key before you actually make the step. And for some people, it may discourage you because you know that you have all these outside expenses that are outside of what you pay for rent, but you really, really want to purchase a home. Then we got to look at other variables in order to make that happen. Knowing all your numbers is essential. It's actually the key that opens the door because, again, you don't want to feel like you're bound when you purchase a home. And so these are some of the costs that are attributed to purchasing a home. So aside from the down payment, you have your upfront deposit, whether you are purchasing a resale home, so a home that exists already that someone lives in, or you're buying a new construction property where it's brand spanking new, you're buying it off of the design from the builder. In either instance, you will be required to put money up front once you've decided that you're going to accept this home. So you have to have that cash readily available. Home inspection, usually on a resale, that's within the closing time. Appraisal, if you are purchasing a property that is not going to be insured by one of the default insurers, then you will require an appraisal. That's out of pocket for you. Then you will definitely have to have a lawyer handle the transaction for you. So you have to pay them for the things that they do, plus paying them to do those things. If you're buying new construction, there may be new home warranty costs that most times get built in with the price of the property, but you also want to be aware of what it's costing you. Your mortgage default insurance. So if you are putting down less than 20%, then the premium gets added to the mortgage, but it's still a cost that you want to be mindful of. And we'll go into that a little later. Title insurance, this is something that the lawyer takes care of, but that's a cost as well. Fire insurance, that is mandatory for 99.99% of lenders. It protects the bank, but you have to pay for it. So you have to make sure you budget for that as well. Land transfer tax. This is something where the government, has to have their nose in everything. Once you're purchasing a property, the ownership transfer from who you're purchasing it from to put it in your name, they tax for that. You got to pay for that. And that could be a few $1,000s. There's tax on the tax, utilities, there's hookup costs that you may have to pay for as well. In the property that you're purchasing from. Oh my, I'm not trying to scare you guys. Believe me, I'm not trying to scare you guys. Property tax, if the property that you've purchased, the person has paid up the taxes for the remainder of the year, you have to pay them back, right? So that gets added into the costs. Moving costs, of course, and mortgage life insurance, optional, but definitely want to factor that as well. So there's a lot of numbers involved. And so again, down payment isn't everything, but down payment is a very important part of it. So it's knowing that you'll have to be able to budget for all of these things. Okay. Any questions? All right. Some of the down payment guidelines. So in Canada, you can purchase with a minimum of 5% down payment on homes that are up to $500,000. So what does that look like? 500,000, 5% of 500,000 is 25,000. So that would be the minimum that you would be required for your down payment, but you would also have to budget for all of the other expenses that I just listed out. And so that typically can look like an additional 1 or 2, up to 2% of the purchase price. Okay. For homes, anything above 500 up to $999,000, you would have to pay 10% of the difference. So 25,000 for the first 500. The property is 600,000. So 25,000 plus 10% of the difference between the 5 and the 6. So that's 100,000. So 10% of that is an additional 10,000 added to the 25. That's $35,000 that would be required for a purchase of 600,000. Plus your closing costs and all of the legal fees that I discussed earlier. For any homes that is $1 million and above, a minimum of 20% down payment. So that would look like $200,000. Okay. Now, when you are putting less than 20%, right? So any home that you're purchasing that's less than $1 million, you would be required to get what's called default insurance. And so this, again, benefits the bank, but you pay for it. But what it does, it allows you to purchase with as minimal down payment as possible. And so, of course, there's a cost to this. This cost gets added to the mortgage, but I want you to take note. So at the bottom of the chart, if you're putting up to 5%, that means you would need 95% financing. The premium cost is 4%. So that gets added to the mortgage. So essentially you're putting down 1%. So you only have 1% of the property value invested. Now, of course, you get in where you can, but I do encourage the more that you can put as your down payment or work towards your down payment, the better for you, right? Because as you see, as the down payment amount increases, you have 10%, 15%, and 20%, the premium decreases. And so if you're putting down 20%, whether it's above $1 million or underneath $1 million, then there would be no premium cost to you. Okay. What are some acceptable forms of down payment? So of course, your traditional savings. I highly encourage you, if you are saving for a down payment, please have your money in an account that is giving you maximum return on your money being in the account. So that could look like a TFSA. Ideally not with one of the big banks, but with another institution that offers, because we'll go into that in another webinar. A GIC that will give you a definite guaranteed return for a period of time, or a high interest yield savings account. Having your money in just a regular savings account in your bank is not doing anything for you, but collecting dust, and the bank is making money off of that. All right. Gifts from family members. There's been plenty of articles about the bank of mom and dad, and if you don't have the luxury of having mom and dad give you a down payment, I can relate to you. But having a family member, it can be a mother, a father, a brother, or a sister, it has to be immediate family, that can gift you your down payment, whether that's 5% or 20%. There just has to be documentation. Everything has to have a paper trail. So if it's coming out of one account, we have to have proof of that account, 90-day banking history, and then we have to show that money being deposited in your account and also showing a 90-day history. And once that's proven without any concern, then it's acceptable. And it's as long as you don't have to pay it back, okay? We have the RSP, and I'm going to go into these ones a little bit later. RSP, which is a registered retirement savings plan. If you do have these options at work, I encourage you to take advantage of it, even though I'm not the biggest RSP member. But there is an incentive program, the home buyers plan. So if you do have funds saved within your RSPs, you can withdraw those funds to use as a first-time buyer and purchase a property without any penalty. There's the first-time home buyer incentive program, which is also referred to as a shared equity plan. Affordable home ownership programs vary from province to province and municipalities as well. And this is where in some municipalities in Ontario, for sure, they will give you the down payment, where so you don't necessarily have to come up with your own. You are responsible for your own closing costs, so that extra 2% that I talked about earlier. These programs are very few and far in between, and then because of the housing prices, a lot of them had to put their programs on pause, because there's a lot of restrictions in terms of the maximum buying power, the maximum income you can earn to qualify, and things like that. And so people weren't able to find houses within the budget that they're allotted. So a lot of the municipalities have put those programs on hold. You can also borrow your down payment. This is something I definitely don't encourage unless it's from a family member, and let's say you know that you're going to be getting money in a short time, then of course. But if it's from any type of debt, like a line of credit or credit card, I totally do not encourage that. But if you do, know that we also have to factor in that liability cost into the qualifying criteria. And so by borrowing your down payment, it could actually reduce your borrowing power. Okay. So again, always boils down to the numbers. So just to go a little bit more into the first-time homebuyer incentives. So I mentioned that we have the home buyers plan. There's also a home buyers tax credit that your accountant can process for you the year after you purchase your property, that you get credited on your taxes. But the home buyers plan and the first-time home buyer incentives are what are the most popular ones. And what was I going to say? The land transfer tax, that's also an incentive. So the home buyers plan, this, as I mentioned, you can withdraw up to $35,000 if you have that saved. If you don't have that saved in your RSP, you can get an RSP loan and have that deposited into your RSP, and then you can withdraw it 3 months later and use it towards your purchase of your property. Now, of course, if you're taking out a loan, again, that liability would then have to be factored into your eligibility. So again, working the numbers and making sure it makes sense for you. All right. But knowing that when you do deposit into your RSP, that does trigger a bigger tax return for you. So as long as the numbers make sense, that is definitely an option for you. Each person on the application, so if it's you and a partner, you and a friend, each of you can withdraw up to 35,000, so total of 70,000 per couple. All right. And that fund that you're withdrawing is tax-free until it's tax-free if you pay it back within the 15 years. But if you don't, then they will prorate the taxes and it'll be added as income, and then you'll be taxed on that. All right. You can also use this incentive program to buy a property or build a property for a relative that you have that may have a disability. Okay, the first time home buyer shared program. This came out a few years back. It hasn't been very popular for the very reason that essentially what you're doing is going into business with the government. Okay. With this program, you have to have at minimum your own 5% down payment. And what they will do is match your down payment. So if you have 5% and you're buying a resale property, they will give you an additional 5%, which would mean you would have a total of 10% down payment to purchase your property, therefore having a smaller mortgage, lower mortgage payment. That loan that they've given you, you're not making any payments on it while you're in the home because they've secured it against the property, secured against the title. So what will happen is once you decide to sell the property, or if you don't sell the property after 25 years, based on the value of the property at that time, so whether it's a sale or at 25 years, you will then be required to repay them. And what you'll be repaying them is the 5% that they've given you, but not of the purchase price, but of the current market value. So if you purchased originally at 500,000, you had your 25,000, they gave you an additional 25,000, right? 5 years later, you decided to sell, but the property was now worth 600,000, then you would have to repay 10% of the 600,000, which would be about 30,000. They make money off, they're making bank off of us, even off our paychecks. Come on, this is what they do. This is what they do. If you're purchasing a new construction property, they will give you up to 10%. So you would still have to have your minimum of 5%, and then they would give you an additional 10%, meaning you would have now 15% down payment. And then the same applies once either you sold or you had the property for 25 years. At that time, you would have to repay them back the 10% of the market value. If the property decreases at any time, you still have to pay back the same percentage, but it would be based off the value at the time. Okay, so you're in business with the government. All right, this is another program that they've announced that is supposed to come into effect in April of this year, and it's the new tax-free first home savings account. So this is an account similar to an RRSP where it allows you to save money, but specifically for buying a home tax-free, right? And so what that means is you can save your money in this account and have it invested, allow it to grow without being taxed on it. And then you can withdraw it up to $40,000 without any penalties on the withdrawal also. So I think I like this program better than the RSP, but you can also use them together. So if you have RSPs and you also do this, you can use them together. This, of course, has some limitations. You can only contribute up to $8,000 per year. And you have to use the funds that are in this account within 15 years of opening the account. See, they give you a little, then they take back, but I digress. So how do we determine how much you can afford? So the three main things are your income, any debt that you have, and of course your down payment, right? How much equity you are bringing to the purchase. But then we plug it into our system and then we get these things called debt servicing ratios. So your gross debt service ratio is 6 GDS, called GDS. What that comprised of is the mortgage payment, the property tax, heating costs. If it's a condo property, we use 50% of the condo fee, which is very helpful because some cases condo fees can be hundreds of dollars. And we divide that by your annual income. We do use your gross income to qualify you. So that's a good thing because we know that you don't bring home gross. And so that service ratio cannot exceed 39%. And then on the flip side, the total debt service, it's everything on the right, on the left side. It's probably your right, on the left side, plus any type of expenses that you have reporting on your credit bureau. So of course, if you have credit cards, car payments, loans, student loans, anything that's reflected on your credit bureau, we take those monthly payments and add it to the liabilities. And so that debt service ratio cannot exceed 44%. Anything, if for example, the property that you're interested, we plug in all these numbers and your servicing is above these numbers, one of two things: you either have to have a lower price or increase your down payment in order to get that. Okay, these are like hard stops, unless we go to alternative lenders where you will be required to have a minimum of 20% down payment, but the debt servicing is a lot more flexible. They're flexible with credit, and you have a little bit more wiggle room in terms of qualifying. But again, the numbers, it has to make sense. Okay. Any questions? Okay. I have some old listings I found in my arsenal. And so we're going to go through some of the numbers to make some sense of what it would look like. Okay. So this property was in Brampton. I think it was a 2-bedroom condo. It sold for $485,000. So it's probably a 1-bedroom condo. I gave you some different scenarios with down payment. So if you were purchasing it with 5%, the minimum down payment would be $24,250 to a maximum of $97,000 if you're putting down 20%. Your mortgage payment would be based on the purchase price minus your down payment plus the insurance premium, if there is one. All right. So in these scenarios, you're looking at your mortgage payment would range anywhere from $2,200 or $1,800 if you put 20% down. Okay. Property tax, maintenance fee. These types of condos, typically their maintenance fee includes heat. So you don't have to pay for heat outside of that. You might have to pay for hydro, so light. So your total cost of this property would be anywhere between $2,500 and $2,900. Can you screenshot? Absolutely. I will also send out the slides. Okay. This property is in Toronto. It's a condo townhouse, like a stacked townhouse. This one sold for $590,000. Going again with the down payment, minimum of $34,000. So remember, it's $25,000 for the first 500, 5% for the first 500, and then 10% of the difference. So that's it's $34,000. 1 second. You're welcome. Or up if you're putting 20%, will be $78,000. Mortgage payments would vary between $2,200 and $2,600, plus your property tax, plus your condo fees. Townhouses typically don't include the hydro and the gas. You kind of pay everything separately. And so this one would be anywhere between $3,000 and $35,000. Okay. Next, this is a detached home. I believe this is also, this is in Toronto. This was sold for $800,000. You can see it's a little bit older. 5% of this one would be $55,000 up to $160,000. And there's no limit on how much down payment you can put, right? If you have 50%, you can put 50%. All right. Mortgage payments range from $3,000 to $3,600. Plus property taxes. So when you are buying a freehold property, like a detached property, there would typically not be a maintenance fee or a condo fee. Claim it, sis. It's all yours. right? There would be no maintenance fee, but you're paying all of your utilities separate. And in some cases, there's, debates that it's better that way, because when you can control your utilities, then you can better budget yourself, right? Versus having a condo dictate how much you have to pay. So yes, the budget would be between 3,300 and almost 3,900. Okay. When budgeting for real estate, I want you to be sure to include all expenses. And if you remember about that pie chart that I showed, those are all the things that we usually pay for. But as you saw, that what we use to qualify you, your mortgage payment, we use your credit card debt or any debt that you have on your credit bureau, and heat. Those are the only things that we use, right? And so life is much more than that. So when you are budgeting, when you're having a conversation about making that investment, you got to factor everything: savings, emergency fund, vacations, student, what do you call it? School savings, right? Income protection, all types of things. You got to think of your entire budget on a holistic level. And therefore, that will help you to be able to have a full, clear picture before you actually make the leap. All right. So who's ready for homework? If you have no questions. No questions? All right. So today's homework, I would like you, see, I'm being nice today. I would like you to do the following exercises. What about student loan? If you have a student loan and it's reflected on your bureau, we do have to factor in what those payments are into the liabilities. And so that will help you well, as long as you're making your payments, it'll help you. If it's not, if it's gone derogatory, that would hurt you. But we definitely have to factor in whatever you're paying towards your student loan as well as a liability. All right. So knowing how much it costs to be you, you're welcome. Knowing how much it costs to be you on a monthly basis is going to be the game changer of your decision to move forward. So I want you to take a minute, review your spending for the last 3 months. Look through your bank statements, look through your credit card statements if you shop with your credit cards, and literally go through line by line and total up how much you've spent on yourself for the months. All right. That's going to give you, for some people, it might give you a small heart attack, but please just, call me. But knowing exactly, you got to be on top of your dollars, right? And so I know years ago, that's something that I didn't do. I just used to swipe and tap and, it would go through, but I never tracked my money. And then once you've done that, you're going to identify, are you in the red? All right. Do you have more month than you do money? Yes, Martina, I am. I am definitely can. Are you in the red? Do you have more month than money? Or are you in the black? You have surplus, right? I'm going to be clear on that. Now that you know, right, after you've gone through that, you're going to break down your spending into essentials and non-essentials. Essentials would be things like rent, if you're paying rent, because you got to live somewhere. If you have a car and you're driving your car to work, you got to, those would be considered essentials. Life insurance, I consider an essential. Groceries, I consider an essential. Insurance, I said insurance already, right? Car insurance, life insurance, those are essentials. Non-essentials would be things like Amazon Prime. My clients are upset with me. You know how many of my clients I made cancel Amazon Prime? Amazon Prime, Apple Music, Spotify, those are non-essentials, okay? And I don't judge, but when you are, as I said, trying to make the move to becoming a homeowner, we got to be clear on where our money is going and on the things that are not giving us a return on the investment. All right. So once you go through that list, that's when you start to make adjustments. And I don't mean deprive yourself of anything. I just mean be wise, use wisdom. Okay. And I also want you to pull out your calendar, and I want you to set your monthly date, money date with yourself. So today, if you do this today, which is January 25th, you should be doing this at least every time you get paid. So if you get paid weekly, it should be a weekly money date. If it's bi-weekly, it's a bi-weekly money date. If it's monthly, it's a monthly money date, right? If you don't tell your money where to go, you'll end up wondering where it went. All right. Any questions? And again, I will send a screenshot of this with the slides, if you like, via email later tonight. So tomorrow, when you come back for the final night, we'll be talking heavily on credit and debt management, but I think I'll also touch on some of the lender expectations with respect to how to get approved for a mortgage. What are they looking for? Things have definitely changed. Lenders have kind of tightened the grip a little bit and are looking for a lot more security when it comes to their clients. So we'll touch on all of those things. And of course, if you haven't followed me yet, please connect with me on social. I'm on Facebook, TikTok, and Instagram. Hardly Twitter, but I got a face over there. Is a stress test still a thing? It definitely is a thing. The stress test is you know what, to be honest, the stress test was very stressful when it came out. It was very stressful when people were trying to qualify with those high prices, but the stress test is really what has us in the position that we have been in, because what the stress test does, although interest rates were super duper low, we had to add an additional up to 2 or 3%, depending on the product that you were taking, add the stress test premium onto the rate that you were purchasing at, to ensure that there's a buffer. Because what was happening, people were purchasing at the top of their budget, and we knew that rates would eventually move. And so like it did, people have been overextended. So it definitely still is in play. It is under revision, because right now it is 2% added to the product rate that so if you're in a fixed rates are about 5%, we have to qualify you at 7%. You're not paying on 7%, but we have to qualify you at 7%, and that impacts your buying power. So it is under review, so I'm not sure what direction they're going to go. They're definitely going to not going to stop it, but they will be adjusting it. All right. So that brings us to the end of day 2. Marsha, do you have a question still? Your hand is still up.
No, did not even know that was still up. My bad.
No problem. So, because in a nutshell, what is the pre-approval process? So in a nutshell, the pre-approval process is gathering all your documents. So income, credit, liabilities and debts, and your assets. So where your down payment's coming from, gather all your documents, have a conversation with your mortgage professional. We review, we juggle the numbers, and then we tell you what your budget would be looking like based on the rates that are available and based on your plan. So if you were planning, let's say you wanted to purchase a property, but it was only going to be for short term, then we would price you based on the shorter terms. If you wanted to, it's going to be my forever house, then we would price you based on the longer terms. In a nutshell. Any other questions? You're welcome. All right. So if there's no other questions, I'm going to sign off. We'll be back tomorrow evening, again at 7:30 for day 3 of the Homeownership Made Easy Challenge. Thank you, Mavis. If you guys have any questions, please feel free to reach out. You are welcome, Charmaine. Thank you, thank you, thank you. I appreciate you all. Please do your homework. All right. It's good to know the numbers, and then you can make the comparison. All right. You can make your adjustments. You can then better plan when you know where you are starting from. All right. So if there's no other questions, I will sign off and I'll see you tomorrow. Have an amazing evening. If you have to go on the road, please, please, please be very safe. All right. Bye, ladies. Thank you.